Today, Federal Reserve Chairman Jerome Powell sat down at the Riksbank International Symposium on Central Bank Independence in Sweden. The topic of conversation, of course, was central bank independence, and panelists included Andrew Bailey, the governor of the Bank of England, as well as Isabel Schnabel, a member at the European Central Bank. A few of the topics they touched on outside of central bank independence include the central bank's mandates, which include price stability and employment stability, as well as political pressures and potential newfound mandates, including the climate mandate. Now, I thought Jerome Powell had a couple really interesting takes, as well as a couple other members of the panel. The discussion was about an hour and 10 minutes long, but I've distilled it to about the most important 23 minutes of the conversation. So sit back, relax, and check out this conversation at the International Symposium for Central Bank Independence. And let me know down in the comments below what you thought of this discussion. Do you think the central banks are actually independent? Do you think your central bank is independent? Or do you think they're controlled by the government at large? Let me know down in the comments below. Like and subscribe if you enjoyed the content. And now, here is the conversation Jerome Powell had with a panel of central bankers in Sweden.
It's a pleasure and an honor to be here today. I guess I'd like to start by thanking you, Stefan, for your friendship, for being a great colleague. You are an absolutely essential person in our world, and you'll be badly missed. I'm going to use my comments focusing on the U.S. context, and I'll address three main points. First, the Federal Reserve's monetary policy independence is an important and broadly supported institutional arrangement that has served the American public well. Second, the Fed must continuously earn that independence by using our tools to achieve our assigned goals of maximum employment and price stability, and by providing transparency to facilitate understanding and effective oversight by the public and their elected representatives in Congress. Third,
before we get to the third point he's about to make, he basically alluded to the mandate that I laid out at the beginning of this video, which is price stability and full employment. Now, most people know that this is the Federal Reserve mandate, and they really shouldn't be acting upon issues that are outside the scope of these mandates.
We should stick to our knitting and not wander off to pursue perceived social benefits that are not tightly linked to our statutory goals and authorities. So, starting with the first point, as Ken and others have pointed out, on the first point, the case for monetary policy independence lies in the benefits of insulating monetary policy decisions from short-term political considerations. Price stability is the bedrock of a healthy economy and provides the public with immeasurable benefits over time. But restoring price stability when inflation is high can require measures that are not popular in the short term as we raise interest rates to slow the economy. The absence of direct political control over our decisions allows us to take these necessary measures without considering short-term political factors. And I believe that the benefits of independent monetary policy in the United States and more broadly around the world are well understood and broadly accepted. However, in a well-functioning democracy, important public policy decisions should be made in almost all cases by the elected branches of government. Grants of independence to agencies like ours should be exceedingly rare, explicit, tightly circumscribed, and limited to those issues that clearly warrant protection from short-term political considerations. With independence comes the responsibility to provide the transparency that enables effective oversight, in our case by Congress, which in turn supports the Fed's democratic legitimacy. And at the Fed, we treat this as an active, not a passive responsibility. Over the past several decades, we've steadily broadened our efforts to provide meaningful transparency about the basis for and the consequences of the decisions that we make in service to the American people. We are tightly focused on achieving our statutory mandate and on providing useful and appropriate transparency. On the third point, it is essential that we stick to our statutory goals and authorities and that we resist the temptation to broaden our scope to address other important social issues of the day. Taking on new goals, however worthy, without a clear statutory mandate would undermine the case for our independence. In the area of bank regulation, as Tobias mentioned, the Fed has a degree of independence, as do the other federal bank regulators. Independence in this area helps ensure that the public can be confident that our supervisory decisions are not influenced by political considerations. And today, some analysts ask whether incorporating into bank supervision the perceived risks associated with climate change is appropriate, wise, and consistent with our existing mandates. Addressing climate change seems likely to require policies that would have significant distributional and other effects on companies, on industries, on regions, and on nations. Decisions about policies to directly address climate change should be made by the elected branches of government and thus reflect the public's will as expressed through elections. At the same time, in my view, the Fed does have a narrow but important responsibilities regarding climate-related financial risks. These responsibilities are tightly linked to our responsibilities for bank supervision. The public reasonably expects supervisors to require that banks understand and can appropriately manage their material risks, including the financial risks of climate change. But without explicit congressional legislation, it would be inappropriate for us to use our monetary policy or supervisory tools, for example, to promote a greener economy or to achieve other climate-based goals. We are not.
That was a little bit of a dig at AOC, if you just noticed. He basically just said, although some of these climate goals may be justified, and, I don't want to get to the politics of it, maybe you do, maybe you don't believe in climate change, but essentially what he did say were that regardless of how noble the goals were, it isn't appropriate for the Federal Reserve to be making such decisions, and these decisions should be left to the policymakers and the elected part of the government. Since the Federal Reserve, they're not a publicly elected part of the government. They're institutionally selected, essentially. So it should be left up to the democratic parts of the government to decide whether these policy decisions are appropriate. It shouldn't be left to the Federal Reserve. Although he did hint at the potential for the Federal Reserve to use some of its tools in what they called climate-related financial crises, which I'm not really exactly sure what that means. I think that leaves a little bit of wiggle room for the Federal Reserve to expand their mandate a little bit, which I don't necessarily like, but I do appreciate that Jerome Powell was being succinct and at least direct with the fact that he believes that this responsibility shouldn't be left to the central banks. It should be left to the policymakers, and I tend to agree with that.
And we will not be a climate policy maker. Thank you. So I'll admit to not really answering the third question. But I'll take a shot at it now if I can. The question being, did either the global financial crisis or the pandemic and the responses to them, does it suggest that there are problems with the mandate, unforeseen tensions between either financial stability and monetary policy and that sort of thing? And I guess I would take the position that would not be my takeaway at all. I think what happened in both crises is that central bankers used their tools pretty innovatively to deal with exceptionally unforeseen and difficult circumstances. I think the main takeaway from the global financial crisis was the need to build far more resilient core of the financial system. And we did that. The banks did that. We did that. All over the world, people did that. And I think that financial system now is now substantially more resilient and more strong at its core. I think it held up better in the pandemic as a result. The pandemic was a different thing. It was it called for a whole of government response from a medical standpoint, and it called for use of fiscal policy and monetary policy tools in unprecedented ways. There had been a concern in the United States that Dodd-Frank had too limited the Fed's authority under Section 13.3 to do facilities and lending.
For those unaware, Dodd-Frank was a reform created after the financial crisis of 2008. So the full name is the Dodd-Frank Wall Street Reform and Consumer Protection Act, and it is legislation that was passed by the U.S. Congress in response to financial industry behavior that led to the financial crisis of 2007 and 2008. Dodd-Frank sought to make the U.S. financial system safer for consumers and taxpayers. Now, it was named after Senator Christopher J. Dodd and Representative Barney Frank of Massachusetts. The act contains numerous provisions spelled out over 848 pages that were to be implemented over a period of several years. The key takeaways include that the Dodd-Frank Act targeted financial system sectors that were believed to have caused the 2007-2008 financial crisis. So the Dodd-Frank Act established a number of new government agencies tasked with overseeing the various components of the law and, by extension, various aspects of the financial system. Components of the Dodd-Frank Act include financial stability, and under the Dodd-Frank Act, the Financial Stability Oversight Council and the Orderly Liquidation Authority monitor the financial stability of major financial firms. Consumer Financial Protection Bureau was created. The Consumer Financial Protection Bureau, established under Dodd-Frank, was given the job of preventing predatory mortgage lending and helping consumers to understand the terms of a mortgage before agreeing to it. The Volcker Rule, which restricts how banks can invest, limits speculative trading, and eliminates proprietary trading. Banks are not allowed to be involved with hedge funds or private equity firms, which are considered too risky, and to minimize possible conflicts of interest, financial firms are not allowed to trade proprietarily without sufficient, quote, skin in the game. The Volcker Rule is clearly a pushback to the direction of the Glass-Steagall Act of 1933, which first recognized the inherent dangers of financial entities extending commercial and investment banking services at the same time. And Glass-Steagall was pretty much created out of the Great Depression, and it basically kept the economy out of a Great Recession or Depression for decades and decades until actually the Clinton administration started working to repeal Glass-Steagall. And lo and behold, about a decade after Glass-Steagall was repealed, what did we have? We had the Great Recession and the need for a Dodd-Frank legislation to come and fill the gaps that left.
The new system actually worked quite well. What it did was it required the Treasury's, the elected part of the government's approval for these emergency lending facilities. And that actually worked very well. And that's actually an appropriate thing because these are extraordinary measures. We only have the authority during emergencies. And to have the elected government approving it, it was a very constructive process between us and the Treasury. So I guess to take a step back, I think that the tools that we have work. I think there's nothing wrong with our mandates. I don't see anything about the laws that govern us or provide our mandates that needs to be changed, and it seems to have worked pretty well in these two very difficult circumstances.
Richard Portis, London Business School and European Systemic Risk Board, where I have learned over several years a great deal from Stefan English. No more of that now, but maybe later. I'm not totally convinced that we now have a resilient system. Mark Carney said that in 2017 as his final statement from the Financial Stability Board. But then the banks, yes. But we found in early 2020 that wasn't true of the non-banks, in particular the money market funds, and the central banks had to step in. Central banks don't like to do that, quite rightly. They don't like to have to act as market makers of last resort. And that may be a compromise of the mandate. So the questions that I would put to the panel, as we've seen, very recently, the rise in nominal rates is exposing financial fragilities in the system. They came from the search for yield, whatever you want to call it. And we saw an extreme example of that in the United Kingdom in September of this past year. Now, in those circumstances, should financial stability be explicitly in the mandate? Should we be recognizing reality, what central banks actually do in practice? Would that help avoid financial dominance if it were in the mandate? Given the huge costs of financial crises, is financial dominance in a sense inevitable? Recognize reality and put financial stability in the mandate. Why not?
Jay, please.
Now, I'm not sure what this guy meant by financial domination, but isn't financial stability part of the mandate already? That's what confused me during this entire question, which is really interesting because he started off his question by listing off all of the qualifications he has and basically letting the crowd know how smart he was. and then he kind of seemed to ask a question that was pretty obvious, but let's see what they have to say about it.
Just to add, in the same spirit, I think that what the pandemic revealed was weaknesses in the non-bank financial sector, much as the global financial crisis revealed those weaknesses in the big banks and the large utilities, financial market utilities. And so there has been, as Claudio was saying, and Mervyn was saying, there's a lot of effort going into, and has been, in what do you do about money market funds? What do you do about the treasury market? These things are much, and I think the first order answers need to be changes to the structure of these institutions to make them stronger, more resilient on their own. I would say expanding the provision of central bank liquidity is not the desired response. It really is to strengthen these institutions. Our capital markets are quite vibrant and very different in what they do from what the banks do. And I wouldn't want to see the kind of prudential regulation that goes along with liquidity provision. I don't think it wouldn't be great to extend that too much into the non-bank financial sector. I'd rather work on structural reforms, which is kind of what we've been doing.
Claes Eklund.
Thank you. Torsten, you mentioned that you did graduate studies together with Stefan. I can add that I actually made undergraduate studies together with Stefan, so I'm even older. But a question of independence. It seems that you have mainly been discussing central bank independence from, let's call it, political pressure. And of course, partisan pressure would be even worse. But there's something more subtle about the independence issue, which I think we can discuss in Sweden right now. I'm personally interested in that. I worked in the finance ministry many years ago, but I was also on the general board of the Riksbank, Riksbanksfullmäktige, not the board of directors, but the general board before, in the old evil days before independence. Anyway, in Sweden we have 4 institutions: the Riksbank, the Financial Supervisory Authority, the Debt Office, and of course the Minister of Finance. And they often work with similar issues, obviously. And they often have to cooperate. So the question here is, how independent can the central bank be in reality? To what extent must the central bank discuss, compromise, lean against the wind or with the wind, and be politically agile at the same time as it is formally independent? Maybe it sounds like a stupid question, but I think actually this is almost as important as the, let's call it, the big issue of political independence. I'd like to hear sort of your experiences from this.
It's actually a pretty important question, because although this is the topic of the symposium, it really, really needs to be stressed how central banks plan to remain independent and what can be done to ensure their independence, because you really don't want them to be essentially an extension of whatever administration is in power. Whether you like Democrats, whether you like Republicans, it doesn't really matter. Picture the other side that you don't like in charge, and having them be able to pull the strings and lower and raise interest rates in ways that will best help them get elected versus ways that will best help the economy, which is actually, what the central bank is at least tasked to do. And remaining independent at least allows them a little bit more flexibility to do that than if they were just a direct extension of a government body. Of course, their independence has come into question quite a bit, as we'll show you towards the end of this video, but it's still an important concept nonetheless, and something we should continue to strive to secure.
Independent can the central bank really be?
Well, can I start by saying, I think we have to distinguish between monetary policy independence, where the case, I think, is very strong, from all the other activities of the central bank. So as a regulator, the United States Fed's very powerful, but there are many other regulators it deals with. And I think the same is true in most countries. So that it's very different conceptually, and I think all regulators, we'd like to be independent from over political influence and being bought off, or even if it's only psychically held hostage by those that it regulates. But I think that's, the central bank in general, and looking at all its functions, it clearly has to coordinate with other agencies. It clearly has to be subordinate to political policy, as we had in the first session here.
So I can speak from my experience, which was that between 1997, when the Bank of England was made independent, and 2013, when I left, there wasn't a single episode where the elected politicians put pressure on the bank to adopt one interest rate policy or change rather than any other. Whereas,
I'm sorry, but I do not believe that whatsoever. I apologize for continuing to pause this video. I'm sure some people are like, just let it play so I can listen, but there's no way that over his tenure at, I believe he said the Bank of England, that there was no pressure from, politicians and other, maybe the prime minister or other institutions to, sway one way or the other. I just truly, truly don't believe that. I mean, I'd love for that to be the case, but I don't know. There's a BS flag that's going off right now when he said that.
as Jay talked about, the facilities that were put in place in the US under the new regime, which was meant in some sense to give more control to elected politicians, we in the Bank of England in 2010 really introduced a compact between the Treasury and the Chancellor on the one hand and the Bank of England on the other, which said that any lender of last resort operation had to be approved by the Treasury. That seems to me perfectly reasonable and appropriate. And you have a private conversation where you explain why you want to do it. And in very few cases could I imagine that the Treasury would say, if the central bank feels that a lender of last resort operation is appropriate to prevent some collapse, the idea that the Treasury is going to say you can't do it, I think is not likely to be true. But since taxpayers' money is at risk, it's perfectly reasonable for the Treasury to have an input on it. There was never any conflict between these two different approaches in the different areas of policy. So I think the important thing is for it to be quite clear what that policy responsibility is, whether it's in the US with changes in legislation or the compact agreed between the bank and the Treasury in the UK. It's quite clear what the lines of responsibility are and who has to be consulted. That's the important thing. That's what prevents, I think, things going very wrong. It's where different institutions or players all feel that they are the people responsible for a particular policy that you get difficulties.
Yeah, or to express it differently and perhaps more simply, it's a big difference between taking the decision in deliberation with others or taking it after deliberation with others.
Yeah.
And that's the responsibility point, right? So, yes, please.
Thank you very much for the panel. Joachim Nagel for the Bundesbank. Let me put it like this. I think it was already said by Ken Rockoff. I think inflation is back now. We are more or less, in my interpretation, still in the midst of a storm, and the storm is not over. So we have to do our job, our main mandate. This is our role. During the last 10, 12 years, we were the most welcome partners of the politicians because we, in our independent role, we did everything to fight against all the financial crisis and did what we did. But this came with a price. And now in the next years, the politicians have to learn that monetary policy is coming with a price. So maybe some of us, they have to announce that there are maybe losses or not the profits we came up in the past. What is your opinion about that? Is that influencing the way we are being perceived in the future about our independency?
Who wants to take that on?
Well, I'll take it on. It's related to something that I said, which is that the pressures from politicians will be greater and more complex today than they were in the 1990s. And you're absolutely right. But I don't think it's an issue about the mandate of the central bank. That is unchanged. It's that some people in positions of political responsibility will learn that life can be difficult. But I don't really see that there is a great wish anywhere to change the formal independence of central banks. But politicians will always want other people to do things that would benefit their own short-run interests. That's where central banks will remain solid and maintain their independence in respect of monetary policy. And they have every incentive to do so, in my view.
Someone else? No?
Well, I'll add briefly. I mean, clearly, there are many cases where, given the central bank's independence, politicians will look to the central bank, as Mervyn's saying, to do something they should do, but they don't want to do, or political interests will say want something to do with inequality or something to do with the environment that they're not getting through the political system, and they'll view the central bank perhaps as an end around being able to implement it. But of course, at the end of the day, the central bank can't take political decisions consistently and maintain its independence. There are deep crises where the central bank just has to act. But I think in that case, it again is looking to the political system to back it up. If you go to developing economies, the normal rhythm of things is the central bank moves, but then the Treasury kind of takes over everything it did, and everybody knows that that's coming, and so it works that way because the central bank can move so quickly. But it needs to be very wary of taking political decisions.
Stefan.
Outside the topic of the panel, but since Ken, you are on the panel, I'll ask you anyway. You wrote a nice little book called The Curse of Cash. And in this environment, cash is disappearing. So what's your advice?
Well, isn't it wonderful that the people who organized this event had a panel just before us about this? But
this guy's funny. He's basically just like, come on, man. Like, you're really going to ask that question here? You could have asked that at the previous panel. Would have made more sense. The previous panel spoke on this exact issue, but he's going to be nice enough to answer anyway. And I'm pretty sure he takes a couple jabs at crypto here as well, but that was a little bit, just a little bit of a funny reaction, in my opinion. It was like a polite way of being like, come on, man, what are you doing?
No, I think one of the things that's been very naive about I will call them crypto evangelists, is that they can somehow do something better and have an end around. And in fact, if you look at the history of money, which is probably what I should have called my book, and you look at the private sector always invents everything, but for many reasons, the governments eventually regulate it and even sometimes appropriate it. And I think, that's what we're seeing going forward in the digital space. You need rules of the road. And
Did you just hear that point he made about cryptocurrency? He essentially, said that it's naive to think essentially that we're going to take over the financial system, which I may or may not agree with. I do think that maybe some of the maximalism that comes out of more or less the Bitcoin group, that the Bitcoin is going to become a global reserve currency. I think that's a little bit of a stretch. I don't really think that's ever really likely to happen. But he takes a couple digs at crypto here, and then he says something that kind of I think he says the quiet part out loud, where he essentially says the private sector does the innovation first. It does something cool first, like cryptocurrency in this case, and then the government later comes along and appropriates it if they need to. Go back about 20 or 30 seconds if you have to and give that a listen, because he basically said the government, if they need to, will appropriate that technology or that innovation, which is exactly what they're doing with crypto with the advent of CBDCs. First, they fought it, they tried to get rid of it, and now they're appropriating it and trying to make it their own and create new rules of the road surrounding their now appropriated crypto technology under the guise of central bank digital currencies. I think that was a really interesting sentence. That there was a lot packed into that, so definitely rewind and watch that one more time.
I was going to bring it up earlier, but I have to mention FTX. That was kind of a success for the regulatory community. It didn't do anything. It's the $32 billion at the heart of the crypto system. just had no effect. And I think it it shows how you need some regulatory structure to provide guardrails, and the central banks need to do that. But anyway, I've learned from you over the years on this issue, so thank you for asking that question.
So FTX was a political success, and then he had a weird grin. So that was very interesting. I'm not exactly sure what he meant by that, but he did go on to say that essentially, if that $32 billion just disappearing from the crypto ecosystem and the crypto collapse that kind of began out of that had no effect on the broader economy outside of the crypto economy. So he basically said, it's not really that big of a deal. Crypto's not really a threat because their financial collapse had no effect on the traditional markets. But then he said, but we still need to clamp down and regulate them. So in my opinion, those two sentences are at odds with each other. I don't think you would stress the need to clamp down on something if it didn't have a broader effect on the traditional economy. So I think that was a maybe not a lie, but a little bit of a stretch of the truth there. But I don't know. Let me know what you think down in the comments below about that thought right there. And let's continue on with this couple minutes left of this symposium.
Oh, since we're spiraling out of control here with questions about anything, we should try to wrap up. So all good things must come to an end, and I'm not going to try to summarize what has been said, but I'd like to end with some final remarks. But really just 1 minute for each of you to summarize for the audience, which is the most important thing that we should take away from the panel. If you had to expound on one, which would that be? Who wants to take that first? Jay?
So I'll just conclude by saying that for us, central bank independence is a matter of statute. It's not in our Constitution. It's just an institutional arrangement that has served the public well, nothing more, nothing less. And as long as it does serve the public well over time, then I think it's safe, and I think it's safe now. But that means we've got to be committed to achieving our goals and to sticking to this precious grant of independence. To keep it, we need to deserve it, and that means stick to that work and don't look for broader things. Where it was discussed at the first panel, really, we shouldn't be getting ahead of where the public is if there's no specific mandate. And in the case of the U.S., that's a particularly salient point today.
Claudia?
Yeah, no,
It's your bottom line.
I fully agree with what Jay just said, and that's also again when you look at the German history. So sticking to the mandate and deliver. I mean, this is what's building trust. And I think when it comes to financial stability, we actually at a critical juncture because the system has not been fully tested. So we have to make sure that we also deliver on both of our mandates, price and financial stability.
Erwin?
All good things do not have to come to an end, and central bank independence is one of them. And I think the point that comes out of all this is you can have a debate about whether interest rates should go up, and if so, by how much, or go down a bit. That's to do with the actual decision that's being made in a moment. But institutional arrangements matter. They really matter, and that's why central bank.
I hate to break it to you, man, but all good things do come to an end, and there's a big debate on whether these central banks are even considered good things or not. I mean, I think there's some fair argument for them to exist, but I do think that as time moves on, we're moving into a digital world, and this digital world is removing middlemen left and right and intermediaries left and right, and I think one of those to be removed will eventually be central banks. Eventually, we'll have protocols that run on open source code that we can rely on as opposed to central banks that meet in private and that lack transparency. Of course, this is a meeting right here. It's not in private. This is a pretty transparent meeting, but who knows what goes on behind the scenes because these are people and people are allowed to communicate off screen, off camera, off phone. However, an open source and public ledger system, whether it's Algorand, Bitcoin, Ethereum, whatever, maybe it's an entirely new chain. Maybe it's not a chain. Maybe it's a Maybe it's like a hash graph, like Hedera or something like the sort. But regardless, these systems are changing. I don't think these, not to be disrespectful, but I don't think these old timers or, the older generation knows what's coming. In fact, I don't even think we know what's coming. I mean, we have a hunch, we see a little bit of the writing on the wall, but the pace of innovation really outpaces most of what we can conceptualize. So I really wouldn't doubt if in 5 to 10 years, there are certain innovations in the digital asset world that we could have never even imagined. But let's get back to the final thoughts here and then wrap up.
Independence, I suspect, will live longer than many good ideas.
I also believe central bank independence will go on for many decades to come. It's hard to know forever. And I would just again argue, as I said in my remarks, that it's really been maybe the most successful policy innovation post-World War II and continues to be.
Okay, let's stop at that and take early coffee. Thank you, with a big applause to the panel.
Thank you. Now, that was a truly really interesting conversation, but I just want to read something from Reuters because this topic of central bank independence has been, quite the rage over the last 6 to 12 months, and it's been a topic widely discussed. So I just want to read a couple things I highlighted in this article. Central bankers are tasked with preserving the value of a currency by keeping inflation in check. For this purpose, many of them are shielded from political pressure from governments. Once a sacred cow in the Western world, this independence has been called into question more often in recent years as central banks stepped in to prop up governments when they were hit by the global financial crisis and then by the coronavirus pandemic. Now, the frontrunner to become Britain's next Prime Minister, Liz Truss, has promised to review the Bank of England's remit, potentially including its ability to set interest rates free from government interference. Now, this is a really interesting conversation because it's essentially akin to a policymaker in the United States bringing into question the Federal Reserve's ability to set interest rates. You really don't want an administration having the ability to have control over whether interest rates are low or whether interest rates are high, and we've actually seen this play out in the Trump administration. Central bankers across the world are under fire from politicians for failing to predict and prevent the current bout of high inflation, which I think is actually a pretty unfair assessment because the current bout of inflation, in my opinion, is actually due to the policymakers. The policymakers are the ones that are creating and then voting on these ginormous multi-trillion-dollar spending packages that is essentially creating the inflation that we're seeing now, and they're the ones that decided to shut down the economies during the pandemic, which caused the supply chain issues. So in my opinion, inflation is almost entirely caused by the policymakers, and then the central banks have to step in. Since it's their mandate to curb inflation, they have to step in and raise interest rates and go against the wishes of the policymakers, so to speak, because higher interest rates hurts the constituents and it makes the policymakers less likely to get elected. But they've got to come in and clean up the mess that the policymakers created. And then they have articles like this written about them. And I'm, of course, a no central bank defender, but this is really, really interesting to read that one sentence that they're under fire from politicians for failing to predict and prevent the current bout of high inflation. How could they predict the coronavirus and then the insane spending that governments did afterwards? And how can they prevent it when it was caused by that insane spending that they don't have a say in? That's policymakers. Those are legislators. But that's beside the point. So what is central bank independence and why does it matter? Of course, I've sort of alluded to why it matters already, but a central bank is independent if it can make policy such as setting interest rates or printing money without interference from elected officials or the private sector. Seems pretty straightforward. The idea is that governments would lean on the central bank to engineer a boom when they need re-election and stop rate hikes that would be too painful for their voters, which is basically what I alluded to before. That's something you do not want. You do not want a government having the ability to, rub shoulders with the central bank and get them to lower rates and print a bunch of money to create an economic boom during their cycle so that way they can get reelected. You want them to make those decisions based on what's best for the economy and not what's best for their reelections. Central bankers should squarely focus on inflation, as we said earlier, sometimes married with another goal such as full employment, and let politicians deal with questions of redistribution and fairness. Absolutely. The policymakers deal with the policy, the central bankers deal with their mandate. That's how it should be. Hopefully it stays that way. But as we've seen throughout history, it's not always like that, and sometimes it's a complete facade. So the data shows that central banks that were more independent achieved lower inflation between 1970 and 1999 than those with closer ties to their governments. Most central banks in the developed world and many in emerging economies are formally independent, albeit to varying degrees. However, the line between central banks and governments can get blurry and is in some cases little more than a polite fiction. Even in the United States and Europe, central bankers are routinely accused of bankrolling states with massive purchases of government debt, which have become common since the global financial crisis. Now, an independent central bank hasn't always been the norm, and the idea of having a fully independent central bank was discussed by economist Milton Friedman in 1962, who actually dismissed the idea on the ground that it wouldn't survive the first real conflict with government. The Federal Reserve has enjoyed operational independence since 1951, but presidential interference lasted at least into the 1970s, and some suspect it's still going on to this day. At least there was an attempt at interference during the Trump administration when Trump was trying to pressure Jerome Powell to keep interest rates low back in 2019. So that was the symposium on central bank independence in Sweden with Jerome Powell, members of the Bank of England, the European Central Bank, and others. It was a really interesting conversation. Of course, we followed it up just now with a little bit more of background on what central bank independence is and why it's so important. Let me know down in the comments below what you thought of the video, what you thought of the conversation. Do you think your central bank is independent? Do you think it's actually just an extension of the government under the facade of being independent? Let me know your thoughts down below. If you enjoyed that content, smash that thumbs up button, consider subscribing to the channel, and hit me up down in the comments below with your thoughts. That is all for today's video, and we will catch you in the next one. Thanks.